Good afternoon for most of you. I think good morning for some of you, and good evening for one person who's joining us from Singapore. My name is Paul Burkett, and I'm the CEO of Automation Finance, and I also run the Automation Finance Reperformance Fund number 4. And what we'll be talking about today is the performance of that particular fund, and what the real estate market looks like at the moment across the US, and more specifically what the mortgage and non-performing mortgage market looks like at the present time. In previous versions of this, people have said it was too much detail and too long, and others said there wasn't enough detail and it was, I guess, therefore too short. So I guess you can't please all of the people all of the time, but the people who ask for it to be shorter will win this time, since we only have a handful of pages. The purpose of this presentation is to update our existing investors, but also to start a conversation with new prospective investors, because we've reopened the fund to raise a further $5 million between now and the end of June, because we have other deals in the pipeline that we want to fund. So that's the purpose of this. As many of you know, we are a regulated SEC fund, so I need to take you through some disclaimers. So I'll just get the screen share going there. So I'll talk you through the business update. I'll give you a bit of an outlook on what we think is happening in the market, and then we'll have some time for Q&A. Shouldn't be more than half an hour, I think, in total. And any questions, you can type a question in the question box, and Albert will help me out by letting me know that I have a question I need to answer. So firstly, we are an SEC regulated fund. Everything I talk about here is not a solicitation. The solicitation can be found on the SEC website, or indeed on Automation Finance's website. The results that we've enjoyed to date are not guarantees of the future, and all investment involves some sort of risk. Indeed, even holding cash involves some risk of inflation. So with that said, I'll move into the main part of the presentation. We are a non-performing fund. We've been going for about 8 years now, and we've run 8 or 9 different entities over the period, and our returns so far have been around 17% a year. More laterally, we have a couple of funds that doing far better than that. Really, anyone who's in the real estate business or the mortgage business at the moment is doing pretty well, because values have moved up so much. We have 2 open funds at the moment, outside of the one I'll talk about today. I featured this one here, Island Cap, which has generated about $6 million. It's probably another $6 million to be generated from that entity over the next 2 to 3 years. Albert,
sorry,
question?
Paul. Yes, sorry. I'm just getting some comments here that I think the previous view is probably better for viewing.
Okay, hold on.
Because some people are just looking at the speaker node at the moment.
Okay. So like this.
Yeah, let me just ask. Okay, yeah, I think we're good.
Okay, so the bottom right-hand corner is the other open fund at the moment. It has generated about $6 million so far, and we'll probably get to 12. I think we'll actually get substantially ahead of that, simply because the value of people's homes are increasing so rapidly, and that's makes everybody look like they're doing a lot better. The fund itself targets an 8% return. We've paid 8% so far, but that doesn't mean you'll always be able to pay 8%. And we also offer best efforts liquidity. And we've had one or two people having to withdraw their money due to the pandemic, job loss, and so on. And so we were able to repurchase their units from them, and return their money to them. And instead of them getting an 8% return, there is a 1 percentage point of return cost associated with doing that. But has only applied to, I think it's 2 people, Albert, but maybe it's even only 1, but it's a very small number of people. So we'll offer best efforts liquidity if people do want to leave the fund. We will work with them to do that. We can't guarantee that we can do it, but we will do our best. What are we actually doing? We're buying mortgages secured on residential real estate. Most of the mortgages have a recent pay history. In other words, they paid a year ago, or maybe even 2 years ago, they made 1 payment. Some of them will have made no payments at all, but most of them are paying maybe 3 out of 12 months. So they're making some effort to pay, but they're not paying as per their mortgage contract, which is that they must pay every month. And as I mentioned before, our prior funds have generated 21.5% annual return, but that's not something that you can take as a guarantee for the future. Now, this chart won't work so well because it's designed to be displayed on the full screen. But if I can just talk you through what exactly it is, the business that we're doing. So if you look on the left-hand side, we're buying loan on this sample home here. We're buying it. The borrower owes $120,000, but the house is only worth $100,000. And this borrower stopped paying because maybe they fell sick, maybe they got divorced, something has happened in their life which meant that they can't or chose not to make payments on their mortgage. So that creates an opportunity for our fund, because the bank that holds that mortgage under current accounting rules must provide for the entire balance on the loan as a bad debt. And so often they will sell that loan rather than hold it on the books. Not often, not always, but often. And typically we'll pay about 65% of the value of that, so $65,000. So that's 65% of the value of the house, not 65% of the balance on the loan, because there is no equity between these 2 points. So we'll base our value on what the house is actually worth. And so that's how you end up owning the mortgage. And so once you've bought the mortgage, the next step is to negotiate a deal. So we go to the borrower through our licensed loan servicer, and they say, look, we want you to keep your house. And what we're going to do to help you keep your house is we're going to forgive this portion here. We're going to write down the loan, down to the loan value, to the home value. And the reason we do that is because if you are underwater on your home, particularly if in the typical assets that we're buying, which would have an average value of under $250,000, these are not wealthy people who are strategically defaulting on their mortgage. These are people who are struggling to make ends meet. And so it's an insurmountable problem for them if their house is only worth 100 and they owe 120. It makes more sense for them to just walk away and lose the home to foreclosure. We don't want that to happen. So we work with them to write down the balance and return their value, to put them back in equity, if you like. So now they have a vested interest in keeping the home and making monthly payments. And in the majority of cases, that is what they do. So the pitch to the borrower is, you keep your home, you make monthly payments. The payment is usually a lot less than what the equivalent rent would be if they had to move out and rent somewhere. They avoid bankruptcy, and they can get their life back on track. And that's really it in a nutshell. You're taking a non-performing mortgage and you're converting it into a performing mortgage. Easy to say, but there's quite a bit to do to actually make that happen. But that's basically it in a nutshell. So what's happened since the last time we spoke? I'll have to just do this manually. So the fund, we started it in around June or July of 2019. And every month we've paid our annualized 8% distribution to our investors. We haven't been late and we haven't missed any payments. But the problem that we had was it was very hard to buy loans during that period. So for the back half of July, of the back half of 2019 and into the back half of 2021, we were actually sitting on cash. We had 2.2 or $2.3 million of cash that we couldn't find deals that we thought were good enough to spend the money on. It wasn't, in fact, until the middle of 2021 that we found deals that we liked. And we managed to deploy all of our funds in those transactions. And so they went like this. The first one was 19 loans. So we bought them for $770,000. That allowed us to buy $1.1 million of loan balance on loans that were on houses that were worth 2.6 million. So we were actually paying 29% of the property value. Some of the loans were cash flowing, and some of them weren't. So on an annualized basis, they were producing about 8% return on those 19 loans. And the reason why the return was low on those was because only half of the pool was actually making any payments. The other half were not making any payments at all. We then bought a further 9 loans for $1 million, a further 8 loans for $451,000. And they again were giving us a total balance of property value of about $9.6 million. So we paid $2.3 million for $3.7 million of loan balance secured against $9.6 million of houses. So about 25% of the property value. That is unusually low, but we were able to source some deals that were, relatively speaking, compared to buying non-performing mortgages, you're buying loans that were very deep in equity, and the borrower had a lot of incentive to make sure that they don't lose their home. And so 6 months of cash flow was $284,000. So that might strike you as odd that you've only paid $2.3 million, and within a relatively short period, you've generated $284,000. And that's explained by this $198,000 here. And actually, if I just delete that box completely and show you this one down here, the reason why the numbers are so big in that 6-month cash flow is really for 2 reasons. If I take the September, so we must have bought these in maybe June, July, July probably. By September, they're starting cash flow. 11,000 the first month, 20,000 the second month, 15,000 the third month, then 48,000, then 17, then 172,000. And the reason for that is there are 2 numbers here, 32,000 and 164,000, let's call it. They are payoffs. So when you're buying the loan, as I showed you in this example here, we pay $65,000 for this loan, and we write it down to 100,000. When that borrower sells the home and moves, we get paid the full 100,000. We don't just get paid the 65,000. So the question that comes to me most often is, if you're paying 8% to investors, how are you making any money? Well, we don't really make any money on a monthly basis. Maybe we make $1,000 or $2,000 or $3,000 or $4,000 per month from these monthly incomes. Where we make our money is when a borrower sells or a borrower refinances, as happens here. So in these 2 loans, between them in 2 months, we've generated $200,000. Our purchase price for those 2 loans was $105,000. So that's really how the money gets made in this business. It's a back-end type business. You don't make money every month. You make money at the end when everyone's been paid off. And so that's the way we structure the fund. That's why we structured it. We don't take management fees on a monthly basis. We pay the investors first. So that's where the 2.3 million has gone. I think we've about less than 100,000 of the original funds still in the bank, and we're looking at a couple of deals right now which will deploy those funds. And so here's one. This bid went in today. And so this is another unusual one. It's about 20 loans. It's actually 19 loans because one of them there's a problem with, we can't buy it. The total balance is just $1.5 million. So they're very low balance loans, relatively speaking. And we bid just around 70%, about $890,000. And these are the sort of homes we're talking about. These are not luxurious mansions. And this is one from the pool. I can't give too much detail with regard to addresses and so on for confidentiality of homeowners, obviously, but it's in North Carolina. It's Zillow thinks it's worth 136,000, hasn't been rehabbed. It's a very basic home. But below it, I've just sketched out the details of this deal. So the average property in this pool is worth about 295,000. The average loan balance is 67,000. So and the average seasoning, which is how often the borrowers have been paying, is mixed. Some of these loans are actually paying. So before I said we pay about 60 cents, you can see here I'm paying 70 cents. Well, the reason for that is that these loans are generating at the moment $110,000 a year. Now that may not continue, they may stop paying, but at the moment they're paying $110,000 across 20 different loans. And our plan here would be to buy these and hold them until they've made 12 of 12 payments. We may hold them longer, but if we just hold them for a year, we can then resell them. And what would that math look like? Well, assuming we collect $110,000, which is what they're paying right now, after the loans have been current for a year, you'll sell them for about 80% of the balance. So 80% of 1.5 million is 1.2, just a touch over 1.2 million, plus the 110,000 that we collected in monthly payments, gives you 1.3 million. And you paid $890,000 for the loans, which gives you a return of about 47%, $400,000, a little over. Now that's in absolute terms, it's not a rate of return, because a year and rate of return, it's not going to change the number too drastically. So I wanted to keep it as simple as possible. This does not account for all your costs. You will have probably some legal, you will certainly have some legal costs, and you will have some loan servicing costs. But relative to these numbers, it's a 1 or 2% difference over a pool like this. So it won't change the numbers so much. And these are the deals that we're seeing more of in the market at the moment. They tend to be not the typical non-performing loan deals that we would typically buy, which are slightly higher value real estate, slightly more delinquent. It's been delinquent for longer. We believe that we have an edge in buying these loans, and we can get them reperforming, get them performing again more quickly, and which allows us to pay our investors and retain profits when all of the loans have been eventually resolved. I mentioned before that the outlook for the market, at least in our opinion, continues to be exceptionally favorable. And one of the reasons that you're seeing, for example, what I showed you here, 2 payoffs in just 2 months, we would see a payoff across the whole company, which is several hundred loans. Maybe 2 years ago, we would have seen 1 every month. Now we're seeing 1 every week. And the reason for that is because housing is on such a tear in terms of values. So when I spoke to you last, the industry was saying that they were expecting house prices maybe would fall, maybe would just be static for a while. I don't think anyone would have predicted that through a pandemic, with all the people losing their jobs and all of the terrible things that have happened, that housing prices would be up 19% in the past year. And I think they were up 16 or 17% in 2020. And so that has 2 effects. The first is it makes those that have homes feel a lot more wealthy. And whether you're paying your mortgage or you're not paying your mortgage, if you see that your neighbor's home is sold for a sum that's vastly higher than you thought your home was worth, it changes your mentality towards your home. Whether you want to rent it out or whether you want to keep it as a long-term investment, you can do that now. In the housing collapse of 2011, 12, and 13, it was the exact opposite. You were watching house prices fall every month, not increase every month. And so that was a terrifying thing for people to have to try to live through. So CoreLogic say the property prices are increasing at about 19% a year. They do think that that's going to slow down a little bit, but just on this chart, you can see this trough here was just around the beginning of 2009. And this chart shows that this is house price appreciation. So how fast are houses growing in value? And no matter which data source you use, you saw that house prices were falling from late 2006 down to 2009 and really recovered. And then through 2020 into early 22, you saw a massive spike in home prices. And this we're right about here because these predictions.
You may dial it at any time during this message.
Folks, would you mind just putting your microphones on mute, because we try and do it as people enter, but it's not always possible. Sorry about that. But what we're seeing is, or what CoreLogic, who are the biggest tracker of real estate prices across the country, are saying is they expect this price growth to start to slow down. And what that will mean is not that prices will slow down, just that price growth will slow down. So I think it's very important to see the difference between those two things. People who've enjoyed this run up in home prices, which is in the 15 to 20% growth across these last 3 years, we expect those prices to remain elevated. And that's really driven by one key thing, which is the ultra low rates that we have at the moment. So the top box here shows interest rate on a 30-year mortgage. So since 2000 at the peak, the cost of borrowing has been trending down, and at the moment it's not at an all-time low, but it's still at around 4%. Anyone who can buy a home should have bought a home over the last few years, especially when you look at the alternative, which is across that same time frame, the cost of rent has increased. Well, you can see it's more than doubled, nearly tripled in that same period. So it makes a lot of sense to own a home. And whether you're paying your mortgage or you're not paying your mortgage, it's a good idea to retain that asset. If something has happened to you, one of the life events that I mentioned earlier, which means that you can't afford to pay your mortgage, the smart thing to do would be rent somewhere that you can afford and rent out your home and keep the difference, keep the spread between what your rent is costing you and what you are renting your place out at. Because the tailwinds behind the real estate market at the moment, you can never say never, but they seem extremely encouraging at the moment. And I think that's why we're seeing so many people paying off their mortgages, and that becomes a windfall for us. Someone whom we have bought the mortgage for maybe 60 cents on the dollar within a year is selling a home. And once that home gets sold, the mortgage is paid off. We don't get repaid the 60 cents, we get paid 100 cents. And in the interim, we pay our investors the 8%, which is essentially all of the cash that comes from those loans as we get them reperforming. So what does that mean for the future? I think what it means is a couple of things. The first thing is supply of new mortgages is going to remain difficult. I remember when these loans were trading for 20 cents, then 30 cents, then 40 cents. And you saw today I'm bidding 65 and 70 cents for things. There was a chance that some of the loans that went into forbearance due to COVID would remain delinquent. 97% of those loans have self-cured, which means they've either worked with their loan servicer to modify the loan, or they've caught up on all their payments, or they've sold the home and in most cases made a profit. In virtually all cases, they've made a profit. So there's unlikely to be a new wave of foreclosures. And that's driven not only by the strong rebound in the economy, but also by the appreciation in home prices. So your house that you thought was worth 100,000 is now worth 120 or 130,000. So you can, even though you may not have been paying your mortgage, and indeed we have one example at the moment where the homeowner thought they were walking away with nothing, but actually they're going to be getting probably 15,000 after fees from selling the home that 2 years ago they would have been walking away with nothing. We expect prices to continue to appreciate, but maybe a bit more slowly. The house prices that grew through the pandemic was a surprise to everybody, but it has really helped our business because no one wants to lose an appreciating asset. So it makes it a lot easier to do deals with borrowers, and it also means that they're more willing to work with us. And in some cases, selling their homes to take some cash and move into a house that they can afford. Many of these people have borrowed more than they can afford to repay. And at some point, they're going to need to accept that and move into somewhere that they can actually afford. We're reopening the fund. We've been closed for the last few months because there were no deals. We've now got more deals than we can fund. So we're raising another between 2 and 5. I think I already have 2. So up to 5, another 3 on top of that, which will get us up hopefully to $5 million on top of the $3.5 million that's already in there. So get us up close to $8 million in this particular fund. The plan is to continue to make monthly distributions over time. That's what most people have opted for. We're working on 2 live deals at the moment. One I've shown you, another one that's similar but slightly larger loans, slightly bigger balances, but more valuable homes. And we would hope to close and fund those deals between now and July. So over the next quarter, the next 3 months. The portfolio overall is performing extremely well. Not just this one, but everyone. And I think anyone who's in real estate at the moment, just all the winds are to their backs and just helping them forward. So we're no different. I think the advantage here is the fact that it's completely passive. There are no fees, and you have best efforts liquidity. So if you need to, or if you wish to get out, we're more than happy to work with you to see if we can facilitate that for you. I think that's about all we have. Just in terms of summary, looking for another $5 million. We pay 8%. Or at least we have since July of 19. We've never been late. We've never missed a payment. We've never made a loss. All investor funds were deployed in the back half of 2021. And since then, across those 3 transactions, most of the loans are paying. All of your loans are never always paying, but most of them are paying. And 2 have paid off, which have more than doubled the price that we paid for those 2 loans. We're working on a few other small transactions. And as I say, we're seeking another $5 million. The minimum investment is $1,000. You, the investor, gets paid first. We get paid last. We get whatever the residual is after all of these loans have been resolved. We do offer best efforts liquidity, and we're working on those deals as we speak. So I'll stop and see if anyone has any questions, and I'm happy to answer any questions on anything at all. So I'll stop there. And to the people who said, can I make it shorter? I did it in 20 minutes. So maybe I can even give you back the gift of time, but I'm happy to take any questions if anyone has any questions on the detail of the fund, on resolution so far, on other stuff that we're doing, anything at all.
And folks, you can ask through the chat or raise your hand.
Oh,
and I can.
Hello?
Yes.
Yes, hi, my name is Camille Jameson from Jameson Financial. So what is the share price going forward to 2022?
Hi, Camille, thanks for the question. So we don't have a share price. The way the money works is you invest it and we pay, it's like a debt offering. So we're paying 8% return on whatever money is put in. So if you invest $100,000, you get $8,000 a year, and it's paid monthly. So there's no capital change in terms of unit prices like there would be in other forms of investment.
Okay, all right. So it's just it would just be 8% of of my initial investment. Is that correct?
That is correct.
Okay. All right. All right. Thank you very much.
You're welcome.
Hey, Paul. We spoke a couple months ago. I wanted to ask, when investors ask you how you source deals and how you find the homes to invest in, what are some of your sources?
So there's really three ways to do it. The first way is the old-fashioned way and the best way, which is calling loan servicers, calling banks, and calling brokers. You build a reputation over time. So we started doing this in 2013, and since then I've probably closed 30 transactions, something like that. And so people get to know you. Just like any business, they're a real business. There's real customers and there are non-real customers. And we have a reputation as being a good counterparty. We always close. And so what will often happen is, like that deal I spoke to you before, that deal that I showed you a little earlier came out to just 2 or 3 buyers. It came out on, I believe it was Tuesday of last week. And today we submitted a bid for almost $1 million. And that's the sort of transaction that the seller wants, because it's part of a bigger deal that they're doing. And to them, it's not the $1 million. To them, it's the certainty of execution. They want this paper gone because it has defects that they're not happy with, and they don't want to be trying to get an extra $10,000 from somebody. And so that's the main way. The second way is I speak at a lot of conferences, I go to a lot of events, and sometimes smaller investors get into this business, find out it's not for them, and want to sell. And we'll offer them the same prices we'll offer a Wall Street bank for their paper, so we can get loans that way. And then lastly, sometimes funds that we do business with will be winding up. So maybe it's a 5-year fund, just like this one is a 5-year fund. At the end of that period, they'll say, okay, we've got 5 or 6 loans left. It's kind of the rock pile, and they've got to do something with them. So they'll put them out for either in an auction where you're submitting a bid almost online, or they'll go to people they know will be easy to work with and take a price from maybe 2 or 3 parties and take the best price. So they're the 3 main ways.
Very cool. And then part B, if I may, that's really cool to hear how everything's sourced. And for an unsophisticated investor, what kind of protections do you have for market changes, knowing that we've enjoyed a very interesting market the last year or 2?
Yeah, I mean, I would say the first thing is virtually all of my money is in here too. And so I treat your money the same way as I treat my own. And we get paid last. So for the year before we found those deals, I was writing the checks each month to pay those dividends. And that's, you can do the math. It was a good few $1 million that we had of other people's money, and I was paying the interest. The key thing though is, if you think of what we're actually doing, if the house is worth 100,000 and we're buying the mortgage for 65,000, you need to have a huge collapse in real estate prices to get from 100,000 down to 65. The likes that we haven't seen since 2008. And I think that the market is much more attractive to me now than it was in 2008, because most homeowners are not mortgaged up to the 100% level. They're mortgaged up to 70s or 80s. So there's no reason to think there'll be another real estate collapse. But like anything, there's always risk. There could be some geopolitical issue, like we're seeing this dreadful event in Ukraine that spreads and causes some massive global recession, something that's as unpredictable as that. Who knows? The thing that allows us to sleep at night is we know that our investment is secured against a home at 60 cents on the dollar or 65 cents on the dollar.
I appreciate the way you answered it, but that's what I was thinking you would say. Very cool. Very cool. The equity, the big gap that would need to happen for there to be an issue.
Yeah.
But yeah, this all sounds great. Thank you.
You're very welcome.
I'm sorry. I have another question. My name is Camille Jameson.
Go ahead,
Yes,
Camille.
Yes. Is there any future talks of going IPO in the future? Another 10, 15 years?
I think that's unlikely. And the reason we wouldn't do it is because the nature of this business is not so scalable that the public markets are going to be interested in it. There are two public debt buyers, PRA and Encore, I think they're called now. And neither of them have done particularly well as public companies. I'm not sure, I don't mean any disrespect to them, but if you look at their share price, it hasn't done really that well. We'd much prefer to stick with being relatively small funds in the 10 to $20 million range. And we think we can run a very successful and profitable business doing that. Maybe one day we could sell it to one of the public companies, but I don't think it's realistic that we would take this business public.
One more question. What is the TAM for this business?
There's more than $1 trillion of mortgage paper, and at any one time, 2% of those are in default. That's about 200 billion. But realistically, most of those loans will self-cure. I would be surprised if there's more than $1 billion of non-paying mortgages in any one month. So something like 12 to 15 billion is probably the total addressable market. But that's off the top of my head. It's very hard to get reliable numbers in terms of market size for the niche that we operate in, if you understand what I mean.
Okay, I understand. Just one more other question. Now, let's just say that the total addressable market is 15 billion. How much of that market do Automation Finance expects to, how much of that market do you expect to profit from?
Well, we typically raise funds in the $5 to $10 million range. And if we could do 3 of those in a year, that would be maybe between $15 and $30 million a year. So it's very, very small in terms of the capital deployed. It's 1/10 of 1%, something like that.
Okay, that's all I have. Thank you very much.
Thanks, Camille.
Thanks, Camille. And I think we have a question from Jessica Gonzalez. Jessica, you want to ask your question? Or I think it's just a question here.
Oh, sorry. Yeah,
go ahead. Yeah, go ahead.
Okay, I just wanted to ask, once you make that additional investment, can you invest additional funds, I don't know, 1 to 2 years later?
You can, and you can, when you do the investment, you can set it up in the portal that you can invest every month. Some people put in every quarter or on a programmatic basis, they put it in frequently. Some people put in 100,000, then they put in another 100, and then they put more in. There's all sorts of different options. It's pretty straightforward to, once your account is open, it's pretty straightforward to change your investment amount.
Okay, thank you.
I'm sorry, I have another question if that's possible.
Of course.
Does Automation Finance plans on getting into other aspects of real estate, or you just plan on purchasing notes? Basically, you just purchase notes. Is that correct?
That is correct. That is all that the business does. We do provide services to other businesses. We manage mortgages for other investors, and we're also in the auto loan business. But we're not getting into the real estate business. We're purely a debt management business.
Okay, all right. Thank you very much.
You're welcome.
Any other questions?
Well, great. Do feel free to send me an email or call. I know so many of the people, actually, I'm just looking at the names, but feel free to reach out. We're actively working on deals at the moment. So if someone is interested, or if many of you are interested, that's wonderful. So thank you very much.
I'm so sorry. I know I have a lot of questions because I'm currently in the business now. So I have another question. What are you going to do about institutional buyers? How does that affect this automation finance with institutional buyers?
Well, we buy from the institutions and have been for many years. We've good working relationships with many of the larger sellers. So, I mean, they've been buying loans that typically they wouldn't have bought historically because values are going up so quickly. And that just means that the prices get higher, but you know, that's just another competitive stress that you have. We feel that we're well positioned to compete with those bigger buyers, particularly for lower value loans, because they don't really want to buy them. Their cost base is too high. We can run them more efficiently, less expensively, let's say, than they can.
Okay, all right, thank you.
You're welcome.
I think that's all the questions that we have. There's no more question in the chat as well, Paul.
Great. Okay. Well, Michael, Jessica, Camille, thank you for your live questions. We'll do another update really when there's any other news. The great thing about this business, well, one of the great things is there's not very much to report. You get the loans and you get them reperforming, and then you distribute the cash. So get your excitement outside of the mortgage business, I think. Okay, everybody, thank you so much for your time. Have a wonderful afternoon or evening or morning, and we'll speak to you soon.